Welcome back to Abundant Culture Podcast,
where we dissect the mindsets and tactics of the true beasts of business.
People like Gary Vee, Grant Cardone, and Warren Buffett.
All to create a blueprint to experience life more abundantly. Hey everyone, super glad to have you back today. And today we're really excited because we're interviewing somebody who was actually supposed to be our first guest on our podcast, but he's a very busy man, hard to keep track of. But the reason why he's very busy is because he is a co-syndicator who has raised capital for literally hundreds of units of apartment buildings. So we're going to talk about multifamily again today from a slightly different perspective, and we can't wait to introduce you to our friend, John Casmon.
So, John, thank you again for coming on to Abundant Culture Podcast. We learned so much from you, so we know the audience is going to learn so much from you too. So before we get into all of that, we need to know, how did you get into business? What is your backstory?
Yeah. So one, thank you for having me on the show. I love Abundant Culture. It's a great platform. I check out the podcast every week, and I hope your guests are doing the same. So thank you for putting this content out there. The culture needs it. So really appreciate that. I got started in business. I guess as a young kid, I was always interested in business. I was always interested in money and making money, the way money worked. We didn't have a lot of money growing up. So I was always curious of why we didn't have money. And when the people who did have money, I was curious of how they had money. And, you just start learning and start to figure out some things here and there. And ultimately, I started to realize that it was either about business, owning companies, stocks, bonds, mutual funds, things like that, owning assets, or investing in real estate. So again, still owning assets, but real estate being a more specific asset. So marketing was something I fell in love with. My senior year in high school, I took a class, it was about public relations, and it really was understanding the way the media is used to influence the way we think. And it blew my mind. And I just really wanted to learn more about media and marketing and how messages were putting together. So I studied communications and marketing in school. Coming out of college, I went into advertising and, did advertising for 15 plus years, advertising and marketing. But I was always still very passionate in owning assets, and in particular real estate. And, one day while I was in school, in college, I read Rich Dad, Poor Dad. And that really opened up my eyes and answered those questions I had as a young kid about money and how people were accumulating money versus those who didn't have money. And that really allowed me to start to think about our finances and how we were going to kind of lay the foundation to have wealth and independence.
Awesome. So I noticed that in your career, you love real estate in general, but your favorite type of real estate, if I'm not mistaken, is multifamily. And can you tell us why you choose, I guess, the larger multifamily deals that you choose over maybe the smaller multifamily deals or single family homes?
Yeah, so I think, with anything, what you want to do is you want to find a way to scale. Whatever you love, you can make money doing everything. I'm not one of those guys who says, hey, the only way to make money in real estate is doing it my way. No, absolutely not. There's a ton of people I know who have very different strategies who are crushing it. But the reason I like multifamily is I think that when you look at the complexity of all the different strategies, the ability to scale, the ability to put a good team in place, the ability to build systems, and to not necessarily just create another job, but to create a system that truly delivers passive income. I really love multifamily from that perspective. So let's just quickly compare multifamily to a couple other asset classes. So there's single families, right? So you can invest in single family houses or multifamily houses. The challenge with single family is that you're buying one house at a time, and they're going to be scattered out. So even if you have 100 houses, they're scattered out all over the city. And that's if you invest in one city, right? So they're scattered all over the city. You have 100 roofs, you have 100 mechanical systems, you have 100 lawns to take care of. There's just a lot of complexity there that you're always going to be maneuvering around to get those done. Think about the loans. You have 100 loans that you're putting on there. Now, yes, you can do a portfolio loan or things like that, but there's limitations on what you can do. On the other side, you buy a 100-unit apartment complex. That's one loan. You have a few different routes there, but they're all one system, right? Or all centrally located. You can hire a property manager who can live on the property. They can manage it. It can be very efficient. So I know it's scary to a lot of people, but in reality, when you scale up, you drive efficiencies just like any business. You get to a point where you're doing everything by hand, but the moment you can scale up and bring on help and hire people to help who have specific jobs and specific roles, it actually makes running the business easier. So the big difference to me is single family house investing. It's an individual landlord type business. When you buy multifamily apartment buildings, especially the large scale apartments, you're really buying a business where you're able to use the systems and tools to invest. Now, again, my background is in business. I work for large corporations, I work for large advertising agencies, small advertising agencies. So it really is about understanding the numbers, hiring the right staff, the right team, and being able to oversee them and execute.
Yeah, that's so awesome because me and Jasmine at the moment are working on like different, business acquisitions and things of that nature. And we took a lot of the things that we learned from multifamily and just applied it to different other types of industries because when we first got into it, we started to realize how much of a business it actually is. Like, what I always say is that the multifamily structure, like the building itself is the product, but how you manage it, how you bring in tenants, how you turn units, different things of that nature, all of that's part of the business. So it's like you have to know this product, but you also have to know this business within inside that operates this product. So I really like those points that you made.
Yeah. So since you are into multifamily, how do you choose the deals that you do?
Yeah.
Great question. There are a couple of things we look at before we even jump into a deal. Part of what we want to do is we want to understand the team. So who's going to be involved in this deal? Who are the people, whether we're leading the operations, whether we're partnering with another operator? We want to really understand the team. What experience do they have? Who's the property manager going to be? Who are the contractors? Just who's the team that's going to be involved? And if there's a weakness or there are things that we need to adjust, then we do that. Sometimes there are things where none of us are perfect. There's no such thing as a perfect deal, but we have to create, those great opportunities. So sometimes you have an opportunity and maybe a good deal, but maybe if you bring in the right person, they can actually make that good deal a great deal. So I'm looking at the team first and foremost. The second thing I'm always looking for is the market. Where is this property located? What's happening in the market, both from a macro level as well as a sub-market level? Because there are things that we can't control. I can't pick up a property and put it into a great neighborhood, right? I can do all the renovations in the world, and I can make something look like a beautiful Class A apartment complex. But if it's in the wrong neighborhood where the desire is just not there for people to live and pay high rents, I'm not going to make my money back. So I'm looking at the market. I'm looking at population growth, job growth, those different factors, what's happening with the market. And then on a sub-market level, again, what neighborhood, what are the schools like? What's the infrastructure? Is there a highway there? Is there a train nearby? What's going on? Why would people want to live in this neighborhood? And then finally, I'm looking at the actual asset or business. So I'm looking at the income statements. I'm looking at the rent roll. I'm figuring out what my investment amount's going to be. But I'm looking at the property itself, right? So what's going on? Is there deferred maintenance? How much money do we need to invest? And all of those different things. And if we can come to a point where we put a valuation on that project and what we think it is today, what it's worth today, and then what the valuation we feel will be in the future based on our business plan. And if we feel that, we can execute and we can buy it at the right price point, we'll move forward.
Awesome. So you hit on a couple good points there. So the things that just to recap a little bit. So the things that you look at is one, the team. Mm-hmm. And then you look at the market itself. And then after looking at the market, you do look at the asset. So I really think that's truly key because when I was, still learning real estate, I was a lot of times very fixed on the asset and not as much on the team and the market. So for anybody who's new out there, like, do not make that same mistake. Like, if you just know the asset and that's it, like, you're missing, this whole other part of the real estate industry that is the market and the team. And the people who understand the market and the team better than you are all the time going to, like, outbid you because maybe they know something that you don't know, or maybe you're going to outbid them when you shouldn't outbid them, which is even another, big problem to have. So definitely pay attention to all of those different, facets. And another question I wanted to ask is, there are a lot of people who want to get into multifamily real estate or even commercial real estate. And for whatever reason, they feel like it is more risky. And me and you talked about this before, and I love your answer to it. So for those people who think that it's a little bit more risky to buy this multifamily apartment complex as opposed to this single family home, could you speak to that a little bit?
Absolutely. So I think first and foremost, right, we have to understand what risk actually is. Risk is, it's adjusted. So you have to look at the different factors. And what people are really saying with risk is, hey, I might lose my money, right? They're really thinking about losing their money when they talk about risk. So then you have to say, okay, well, how can I lose my money? On a single family property, you make money from one resident, right? So that one resident's there, they pay you rent, and that's it. If they stop paying you rent or you can't rent it and it sits vacant, then you're going to lose money. All right. So that's your risk there, is you have one source of income coming in and out. And as long as you take care of them, you're good. But if not, you're not. The other issue with single family investing is you could have one big ticket item and it could wipe out your income. Let's say you need to redo the roof. Okay, a roof, I don't know, might cost $10,000 on a single family house, might cost $5,000. But if you're only netting $200 to say $400 a month on your single family property, as far as your cash flow, and you have to pay $5,000 to get a new roof on, well, that wipes out everything, right?
Mhm.
So I think that's the first thing you have to and not only wipes out everything, wipes out everything for the last 2 years of profit.
Yeah.
So that could be, and that could be anything from HVAC system, electrical, like any of those things could wipe you out, right?
Yeah.
So that's one thing on a single family side, is you could have 3 or 4 great years of making $200 a month, $300 a month without any issues. And then year 5, you need to start doing some of these Capex items and it wipes out all of your gains. On the multifamily side, what you have to go back on the risk is, like we said, it's the same risk. It's really, tenants paying rent or not paying rent. And if they don't live there, it's vacant, then they're not going to pay, or they have financial hardships, they're not going to pay. But let's just say on a 10 unit, let's not even go to 100. Let's just say a 10 unit building. Let's say 2 of those people are not paying rent. Maybe one unit's sitting vacant. Maybe one person's just going through some things, but you're only getting 8 out of the 10 units. Well, if you're getting 8 out of the 10 units, that's still going to be enough to pay all the bills as well as pay for your debt service or your mortgage on the property. And a lot of times what most multifamily investors do is we have a line item of money that does go for CapEx. So we're going to make sure that a portion of that money, we're not just going to stick it in our pocket. We're going to put it aside because we know at some point a roof's going to need to be repaired or the AC unit's going to need to be fixed or something like that. And I advise every single family investor to do the same thing, but it just makes those returns look a lot more paltry when you see, 75 bucks going for CapEx and you only made 125 bucks, right? But that's one thing, right? It's really the balancing of the economies of scale. The more residents you have, the more predictable the business is. And we're going back to a business. If you have a small business where you only have one customer, then you're going to be completely reliant on that customer.
Yeah.
On the larger apartments, we have 100 units. If you have a 100-unit complex, we have 100 tenants where, yes, at all times, you're probably going to have a handful of units vacant, but you're probably going to have 90 to 95% of them where they're occupied and paying you rent on time every month. So we can start to predict what's going to happen. We can start to forecast and project what our incomes are going to look like. Now, yes, you're going to have some waves in that, but picture for the people who are watching, you can see this, right? So picture a 100-unit building. The money will do this, right? So when you look at your monthly income statements, it will be a little wavy, but it'll be fairly consistent, right?
Mhm.
On a single family, you may be here, 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 0, back up, 25%. But there are going to be those months where you might not have any money coming in and you're going to have to figure out how to pay for it. So I think that's the biggest thing. I think the other piece is people get scared when you look at the large numbers because they assume that inherently there's more risk involved. Here's the other thing with that. When you're dealing with larger assets, you have a lot more professional people involved because a bank who's putting up $1 million, $2 million, $5 million, they're not just giving checks to anybody. They're going to take a look at you, your business plan, the property management team that you have in place, and they want to vet everything themselves. They're going to underwrite the deal themselves. When you buy a single family house, the bank really just looks at a couple of factors and gives you the money. But when you buy a 100-unit complex, they're underwriting the deal. They're going to tell you, hey, actually, trash should be X amount. So you need to do X, Y, Z in your numbers. So they're going to double check all of your numbers as well. And then the property management companies, you're going to hire much more professional property management companies because you're talking about those higher end or higher price point units where it's a business for them as well. They make their money off of dealing with large apartment complexes. So I think all of those things factored in make it more secure and a little bit of a better bet than single family. The last piece, though, is the flexibility. You don't have to do this by yourself. On a single family property, you pretty much are doing that by yourself. Maybe you get one other investor, but on a large apartment complex, many people are not buying these by themselves unless you're come from a super rich family, right? And you're a family office. But many people are putting resources together. So part of what we do is we actually help busy professionals, folks who have money locked into IRAs or old 401ks, or people who are, just trying to find other ways to diversify from the stock market. But we actually pull all of our resources together to go out and acquire these larger assets. And that really makes it efficient because you have a team of folks who are experienced, who are going out executing these deals, and you don't have to do it by yourself. So I think that's the other aspect is you don't have to now learn how to be a great landlord. You can just lock into a team and a system that's already in place, that's already acquiring these large deals. The same way you would buy a mutual fund or a stock. You don't buy Apple stock and then be expected to go in and, learn how technology and how to grow, the electronics business. You buy you buy a share of that company. And it's kind of the same mentality when you're buying a large apartment complex. You're really coming in, you're going to be a part owner. So you actually will be more, involved in the sense of you own a piece of it, but you're not going to be expected to come in and now figure out, what the rents should be or what paint colors we should be selecting or anything like that. You really can come in and be passive and still learn throughout that process as well.
Yeah.
And you touched on like a lot of great points. And I'm sure like he has questions, but I wanted to make sure I asked my question first. So you talked about team a lot all throughout the podcast already. So like, what are some of the factors that go into you picking out like such a great team to do like a great job on a project?
Yeah, so I mean, every team member is different, right? So I think the first piece is understanding the different roles and responsibilities, and I'll just highlight a few high level ones. You've got your property manager, so that's the person who's going to oversee the day-to-day aspects of the deal. They're going to help to lease units, understand which units need to be turned, just in general climate of what's happening with the property, right? So you have the property management company; they're going to handle maintenance as well, those kind of things. You have your contractors. So if you're doing any kind of construction work or rehabilitation work to the property, you're going to need to hire a contractor to oversee that. In some places, in some markets, the property management company may do those things, but you may need to go hire someone outside of that. You're going to have your brokers, you're going to have your analyzers or your underwriters, folks who are helping you analyze these various deals. And then you may have other folks, maybe a loan guarantor, somebody who's a mentor or coach, or someone who's going to help just oversee making sure you're analyzing the deal the right way and thinking about everything the right way. So those are the different pieces. And you may have investors as well. You're going to have a lender. So, I mean, there's definitely a ton of folks who are involved in this process, right? Here's what you're looking for. One, I'm looking for integrity first and foremost. People who are honest, people who are trustworthy, people who are stand-up character individuals. So I'm looking for integrity and character first and foremost. I don't care how successful you've been. If I don't feel like I can trust you, or if things get bad, I feel like you're going to put yourself first and just, abandon the rest of the team, then that's a big problem for me. So I try to understand who you are as an individual, get to know you. Are you a high character person? And if so, those are the people we want to bring on our team. The other thing that I'm looking for is obviously competence. Is this person competent at the thing we're asking them to do? Now, you have to be careful because sometimes we realize we ask people to do things where it might be a stretch for them. And it's okay to stretch people, but you have to make sure that they're competent and they can read and react, that they are a bit entrepreneurial, or I would say a problem solver. So when things come up, you can start to figure it out. Because in real estate, nothing goes exactly as planned. You don't get a deal, walk around, everything goes smoothly. You hold it for 5 years and walk. There's always going to be something that happens. And there are factors that we can't control. The market, we're talking about an inverted yield curve, for 3 months straight. And that has a lot of people nervous about a looming recession. So what do you do if that happens? How does that change vacancy? So you want to have people in place who are thinking about all these things all the time, because they may have a solution to a problem that you may not have even thought about yet. So you want to have the right folks around, because they're going to make sure that we're just building the right team. So I think those are kind of the two core things. I'm looking at integrity and character, and then the second is the problem solve skills. And then there's small little, I would say communication things that we look for, folks who are, easy to communicate with, folks that you like. The same things I would look for in anything. Do you know them? Do you like them? Do you trust them? Get to understand them. Certainly look at referrals, and just don't go in with a blind spot. I think the biggest mistakes that we've made when it comes to hiring team members is you can notice that there's something wrong or a flaw or maybe a red flag, and you ignore it. And ignoring that red flag is a big mistake. I would say definitely address it, and address it directly. Ask the questions. It doesn't mean that, hey, don't hire that person. What it means is understand it, address it directly, and be on the lookout. And if that behavior or whatever that inclination is, if it continues to pop up, address it as quickly as possible. I mean, you'd rather fire quickly and move on from a team member than have someone in who you're just begrudgingly moving along with. It just doesn't get better. That the hope and wish is not a strategy. So if you hope and wish it gets better, that's not going to help you. So make sure you do what you got to do to keep things moving.
Yeah. So did you have another question before? Yeah. So I have a very specific question, and somehow gotten this far into my career, which is still fairly new, but still this far in my career without actually having an answer to this. So hopefully you can.
That's a lot of pressure.
Yeah, I know. I told you I was going to hit you with one. I'll trip you up. But basically, you brought up Capex before. And that's something that it's always been in my mind. But like a lot of times I don't necessarily have a strategy for putting money away for Capex. So like some deals we'll probably look at, and then obviously you want to have something in reserves up front. But then I hear like a lot of syndicators and investors say, they continually put capital away for, Capex. And at the same time, like you also, I guess, from my understanding, wouldn't want to overfund have this, boatload of cash in the bank that, most of it's you're never going to use. So what's your strategy behind having capital in reserves? Like, do you put some up front and then continually put some up into like a dollar amount or something like that? Like, what's the strategy behind that? Because I never really had a strategy. It's like, oh, put some money there and just pray we don't need it. But, that's not how you should do it. So.
No, it's a great question. I'm glad you asked that question. Yeah. And in short, these are the kind of questions that investors need to ask, and they don't even know they need to ask. And that's why I recommend anybody who's looking to invest in multifamily, even if you've done a couple single family deals, it's great to kind of come in as a limited partner or partner with an operator like myself or other folks who are doing this thing. If you can get in and find ways to add value to them, because it's easier to learn when you have someone like that, or hire a coach or mentor who's willing to take you under their wing and be able to answer these kind of questions. Because you may not even know the questions to ask. And next thing you know, you're sitting there trying to figure out, all right, I got to fix this roof and I didn't put any money away. Now, how do I get the money to go do this? Right. But that's it. Your question was a great question. So the short answer is you do both. You put money up front, and we call it operating capital. So you have your operating capital. That's going to cover not just your CapEx, but you may, depending on what your business plan is, you may have some months where you're lean because you're going to renovate more units or you're going to get out more residents. So you may not have all the money that you get straight from cash flow. So you may want to have some capital sitting there just to make sure through any of those rocky months, you have the capital to do the deals and do the work you need to do. But on an ongoing basis, yes, you want to take a portion of capital, the cash flow that you're getting, and you want to put that aside in the capital reserve account, and you keep that there. And it, people do it differently. I like to do anywhere between $250 a unit a month, and we put that away. So somewhere in that range is kind of what we look for to just stock that away. And if you don't need it, great. Once it's fully funded, so you can get to an amount, you might say, I mean, again, it depends on the size of the deal, but you may have a set number to say, let's just call it $100,000. If you have $100,000, once you hit $100,000 in that account, then you don't have to keep putting more money in that account, right? You can just kind of wait, and if you need it, you draw on it. As you draw on it, you might start putting more money in the account. But to your point, you don't have to just continually stack a whole bunch of money sitting in an account and not doing anything with it. If it's properly funded, especially if you raise operating capital up front, then you may be halfway there already. But if not, you definitely need to put money aside to do that. But then also, if you know that certain things are going to need to be addressed, you should factor that into your underwriting up front. If you know the furnace is 12 years old, then you should expect that at some point you may have to replace the furnace. So you should think about stacking a little bit of money aside for that. If there's only 2 years of life left on the roof, you're going to need to plan on replacing roof. Yes, you don't necessarily have to do that immediately, but you should plan on having to replace the roof. So those are the kind of things, even when you're going into a deal, you should be thinking about. And I'll give you one more great nugget for your listeners. When you're thinking about CapEx and underwriting, you can do a couple of things that are really beneficial. One, you can negotiate either credits or repairs from the seller. And the reason I say the credit is important is if you have a purchase price and instead of having him reduce the purchase price to address it or you fixing it or whatever, if you ask for a credit, it can lower the amount of money you have to bring to closing. So on a deal, it's the same amount of money for the seller, but if it's a credit, that's less money that you have to bring out of your pocket. So that's going to boost your NOI, that's going to boost your returns, and that's going to make the deal, or I should say ROI, not NOI, but that's going to boost your returns, and that's going to make the deal look a little better because you'll have more of your money in pocket versus having to, lower the purchase price, but you still got to bring that 25% down from the bank. So that's a great little, trade that you can do. Another thing, we haven't done this, but I've heard of other investors do this. If there is a reserve account on a large deal, you can try to negotiate that to have that reserve account sent over to you as a part of the transaction. So instead of them just taking that back, keep that reserve account and negotiate, have that reserve account transferred over to you and the ownership. So now you don't have to start all over from scratch funding it.
Nice. The first
That's my
one.
First time hearing that.
Yeah,
one.
the credits I'd heard about before, but I just forgot about it because I haven't used it yet, and I haven't heard of anybody using it recently. But having a reserve account like transferred over, like that's gold. I've never heard that at all. So like definitely that was an awesome gold nugget. The other question I had is pertaining to raising capital. So a lot of people, especially in my network, like a lot of people like, oh, you raise capital for blah, blah, blah. And they think of it as kind of being this cool thing. And I'm like, dude, I'm new. Like I haven't raised anything compared to, like some of my mentors and some of like what I could be raising. And a lot of people, one, they're intimidated by it. And two, they don't really know how to go about raising capital. Is there any tips or nuggets you could give to people in regards to raising capital for these larger deals? Let's say they have been using their own capital for a while to fund different multifamily deals. So they have a knowledge base there, but they haven't raised capital yet. What's some tips you can give them?
Yeah, so I mean, it's a great question, and something that we get asked a lot actually, and we're going to be launching very soon education platform to teach people exactly how to raise capital, how to raise more capital, and there are really three steps, right? So the first step is, and in this case, we're talking about multifamily. So there's the business itself. You have to know the business. So we're going to start off by talking about multifamily, the terms that you need to know, how to underwrite deals, all of the fundamentals that you really need to know about apartment building investing. The second piece is capital raising, right? And the second piece is really important because that's about establishing a network, but also building on the existing network that you have. Who do you know that has money that can invest? And you might know people that you're not thinking about. So think about this when you think about investing. There are people who, maybe have an old 401k. So maybe they worked a job, they left, they went to another job. But what's happening with that 401k right now? Is it
Just
just
sitting there.
sitting in an old mutual fund, the stock, you're not touching it? Well, you can roll that over into what's called a self-directed retirement account. So there's a solo 401k and a self-directed IRA, and you can use that to invest in alternative assets like real estate. So that's one way you can start to educate other people that, hey, you might have more money to invest than you think. And by the way, because this is for the long haul, it's a great investment tool to use to invest in some of these larger deals. The
Yes.
other thing that you can do is there might be people who have homes that are paid off. So maybe they've lived in their home for 20 years, 30 years, 40 years, and they have a ton of equity in their home and but not as much money. So that's something they can use. They can tap into that equity and invest based on some of that equity. They can do a HELOC, a home equity line of credit, and they can use that to invest and actually get money back, or they can do another reverse mortgage or things like that. So there are ways to tap into money that people don't even realize that they have. Now, obviously, if you have cash sitting in the bank, that's going to be the best thing to do. But there may be other resources that people have as well that they can tap into. So when you're thinking about raising capital, you want to make a list. You want to make a list of the types of people in your network. Where do you know them from? So I know you both were in the military, so you might make a list of other folks you met in the military. You may go through, if you went to college, you might have friends from college. If you worked in corporate America, you might think of people that you worked with in corporate America. Maybe you're a part of different organizations, but you want to make a list of these individuals. And I'm not saying you want to ask them for money. Okay. That's a big red flag and flaw. That is not it. Okay. Capital raising is not asking people for money. All right. I want to make sure listeners understand that. That's not what capital raising is, at least if you're good. It is not asking people for money. What capital raising is creating opportunities for people to benefit from investment opportunities. And either they want to benefit from that, or they don't understand it, or they just have other things they want to do. All three are fine. But you have to walk them through the steps of education before you can really get them to invest. That's why you have to know the topic. If you're going to start asking people to invest in a deal, but you can't answer basic questions and they don't know anything about it, they're not going to invest. If they're not comfortable, they're not going to invest. So you have to make them comfortable. You have to study, you have to learn. And that's something we're helping investors do now is understand the information so they can become more and more comfortable having conversations with people in their network. And then, so that's the second piece was capital raising. The third piece is thought leadership, which is something you guys are doing right now, right? Having your platforms, podcasts, blogs, interview, meetup groups, whatever. But that's really the third phase of it is having a platform that allows you to connect to other people, but also continue to educate not just yourself, but your audience on all of the things you're doing. So if you want to be a great capital raiser, those are really the three things you have to do. And that first one is obviously multifamily from what we're talking about, but it's your subject of whatever you're raising capital on. The second is identifying the network that you have and nurturing that network. And then the third is finding a way to become an expert while also growing that network. So that's the platform that we're getting ready to launch here on education. And anybody who's interested, they can reach out to me and talk about that more. But I'm all about giving people information because these are the things that a lot of it I did learn from coaching as well. And a lot of it as well from a corporate standpoint. I was in marketing, so I worked with influencers all day long and major brands who leverage the same strategies and techniques to get their brands hot, and tapping into sponsorships, tapping into celebrities, and tapping into different things to drive business for their brands. And the strategies are very, very similar when it comes to becoming someone of influence, as well as raising capital for your deals.
Yeah. And it's actually funny too, because like we started this, and I'm not gonna lie to everybody. It wasn't for the audience. It was solely because I wanted to network with more people. Now it's for the audience too, though. Audience as well. But when we started this, that was kind of really the reason behind it. And now sometimes we meet with people, like we may set up a meeting, or maybe somebody introduces us to somebody through email or something like that. And then we'll sit down. Like the other day, we sat down with a banker, and he had went through all our social media before we even sat down and talked before. And he thought it was great. And I was like, really? Yeah, he thought it was excellent. He was like, oh yeah, I could tell from your content, you guys know what you're talking about, different things of that nature. And it built almost instant rapport, because we were looked at as like experts without necessarily even saying or, doing anything with him. So I feel like that last piece is something that a lot of people do not do. They stop at the second one. And that's what I was doing before. But like when you take it all the way to having a platform such as a meetup, a podcast, or whatever the case may be, like it is so powerful, because even one of her friends from high school hit her up one day off of our website, which we hardly ever use for whatever reason. And she was like, hey, I've been watching what y'all been doing. Can you tell me a little bit more about it? And she's in the process of raising capital from her family to invest with us. So I'm like, dang, like that just came just from putting ideas and different, posts out there. And people are actually watching. And even if you don't have like a ton of views, like, cause we don't, but all it takes is that one person. A lot of times it's that one view that you're like, oh man, I only got one view, but that one view could be like bringing, cash to your next deal. So it's so important.
Can I give a quick key insight to your listeners?
Yes.
So, and I want everyone to listen up to this. Okay. So a key insight is that there's a ton of information out there, but there's not a lot of the information that people are really looking for. So when you're doing these things, you're putting your podcast, you're putting your content out. If you're focused on the number of views, the number of downloads, and all those things, it can be very easy to get disappointed and to quit. I think there's a stat that almost 60% of podcasts don't even make it to episode 20. Okay. So you have to understand what your goals are. And to your point, you're putting this out because this is really about the law of attraction. What you're hoping to do is you're hoping to attract that individual. And you have to put yourself out there. That's the thing about raising capital. If you're going to go out and talk to investors, you have to be vulnerable. You have to be comfortable being vulnerable. You have to be comfortable with someone saying no. And not just no. It could be no. And why'd you bring this to me? You don't know. I mean, it could be a lot worse, right? They can hurt your feelings with it. It can hurt your feelings. So you got to be comfortable with that, and you got to be able to shake it off. And a lot of people aren't, and that's fine. But if you're going to do it, you have to be comfortable doing that, but then also educate yourself on the steps. Because if you can put this content out there, you're going to attract the people who need to come to you. So if you do a show, and let's say 100 people listen to your show, there might be one person who emails you after the show. Hey, thanks for that content. I was looking for that. Or I didn't know about XYZ, and I'm glad you did. Now that's a person that you've helped, you've given value to. Do you think that person might be more open to a conversation about how you could continue to provide value to him and how they might be able to provide value to you?
Absolutely.
Those are the things that you're doing. And yes, you can have 1 million downloads, but if you're not providing value to people and you're not helping people, what does it matter? It's great that you have your contents out there, but if you're not really providing value to people and helping them do the things that they're trying to do, I don't know how purposeful it is. And I think that there's a sense of purpose that comes in all of this. So you are putting out this content. I would advise anybody who's looking to start a blog, or maybe you have one right now, but if you haven't done it, and if you're not doing it for that reason, or you don't know what the reasons are, you should think about it. Why are you doing this? Why do you want to do this? Is it to meet people? Is it to attract investors? Is it to, do something else? And don't be disappointed if it's not on track to do that. You may just have to pivot, or you may just have to find out where the value is otherwise. I'll tell you what, when I launched my show, I thought it was going to just attract a ton of investors to me, and it didn't really happen that way. So I was disappointed initially, but what I've loved is I love being able to, stay sharp and ask some of the top investors around the country, some of the top marketers, what are they doing to, find deals? What are they doing to engage, brokers? How are they finding the best markets to invest? What tips and shortcuts can they use that they can provide to us and our listeners to find those best places to invest? And then what marketing techniques? Now we're talking more about marketing and social media and branding. And, we're bringing on people who have big Instagram followers. How'd you grow your Instagram followers? How'd you grow your LinkedIn platform? Because those are the things that selfishly they help me, right? But they also help our listeners. And I bring our listeners in on this journey, and all the education that we're growing, all the things that we're growing and we're learning about, we're able to do that. And that's what you guys are with the Abundant Culture. You're helping everyone learn more about the mindset, how to shift, how to think abundantly, and how to do this for the culture. And I love that aspect of what you guys are doing. So, if anyone's doing this and they're creating content, you have to continue just staying positive, and you have to tweak and retool, but just make sure you're continuing to push out that content, because that next article you write, that next episode you drop, the next video you push, it might be the piece that somebody's looking for. And that might be the thing that, changes your own business.
Yeah, for sure. Definitely.
So I think that you were actually reading some of the questions that we were just about to ask you.
I wasn't.
So one of the questions that I had is, what is the number one takeaway that you want people to get from this whole entire episode?
Wow, that's a great question. I think the biggest thing is that, you can absolutely achieve. You have to think big. Don't be scared. So when you think about abundant culture, part of that point is you have to be comfortable thinking in abundance. And whether it is investing, or we're talking about multifamily apartments, everything is doable. You just have to break it down in chunks, right? There's a quote about how do you eat an elephant one bite at a time, right? And it's the same thing with multifamily investing. It's the same thing with raising capital. So I would say, one, think abundantly first and foremost. And if you're thinking abundantly, then reach out to the people who can help you take those next steps to start, eating that elephant. And sorry for all the vegetarians and us weird.
We want to wrap it up to respect your time. So Our final question before we get to your contact info is, how do you spread abundance?
Yeah, so I think there are a couple things. We've talked a little bit about the podcast. So I host the show Target Market Insight. So one of the ways we like to spread abundance is, any information we're getting from guests, all the great tips, techniques, strategies, we share that through the podcast, through the platform. So from an education standpoint, we're always sharing that. We host a monthly meetup, the Chicago Multifamily Club, and we also host the annual Midwest Real Estate Networking Summit. So we're always looking to share all the information, bringing in guests, bringing in speakers, folks who are even way more successful than we are. And it's really just about bringing in those people, not worrying about them taking my candle, right? It's just, people who are thinking abundantly. We're going to cultivate, we're going to curate the best talent. And that's really the approach we like to take there.
Nice. And everybody, by the way, anything that John does is just awesome. The content is amazing, and he always has great speakers on his podcast and at the meetup, and there's always tons of people there too.
Yeah, for sure. It's a great place to network. Seriously, I've met so many different types of people, even in different industries, at the meetup that you host every single month. And I truly appreciate having that platform, because there's not many places where you can go where it's centered around education and also networking. So a lot of places,
and no pitching.
Yeah, and no pitching. And, that makes a lot of people, uncomfortable. But every time I go, I collect a minimum of, 5 business cards. And throughout a year, that's 60 some people added to my network. So like, it's really amazing to be able to go there every single month. So just keep it up.
Yeah. Thank you. I'm glad you all are getting value. I mean, that's the whole point, right? The whole point is give. And, at some point, if you guys follow Gary Vee, I know, right? So, I mean, Gary Vee's got the jab hook, right? And the point is, you give at some point, there may be some things where, we need help with things or we'll reach out to folks, but it's again, it goes back to the integrity and character. If you're building great relationships and you're building a network, you're really building the network. I'm not saying just reaching out to get business cards and, all right, hey, we need this and we call such and such. Well, guess what? If you haven't built the relationship with that person, they're probably not going to want to either invest with you or help you or whatever. So it's always about giving for us first and foremost. And then as stuff comes up, we have a great network. You can figure out everything else, right? So it's always about giving and developing the network first and foremost.
Yeah, for sure. So for the people who want to know about your education platform, your, the thing that you're doing, if they want to know some more about your background, your investment history, different things that you're doing there, your meetup, whatever the case may be, what is the best way for them to get into contact with you?
Yeah, so you can shoot me an email. It's probably the easiest thing, john@casmoncapital.com. I'm sure you guys will link to that, but John@Casmon Capital. They can also go to the website. We'll have all the information available on the website, casmoncapital.com. And then they can always check out the podcast, Target Market Insights.
Awesome.
Well, we really, really enjoyed this episode. And I know people got so much value from it just in 45 minutes or whatever it was.
I did. I definitely did. I'm using a couple of those things on my next deal.
Yep. So thanks for coming on, John.
Thank you for having me. Appreciate it. You all take care. All right.
All right. You too. So that's all we have for today, folks. I hope you got as much value out of this as we did. Keep in mind, the only way we can improve is through constructive feedback. So remember to rate and review this episode. Also, you are not the only person that needs to know this super valuable information. So be sure to subscribe and share as well. Stay tuned for the next episode. And remember to always spread abundance. Peace.